What is investment? Deploying capital in assets that will grow in value and give returns that will beat inflation. Investment is all about future returns and no one can predict the future. Hence, its uncertain nature makes risk inescapable. To be successful in the investment world, it is very important to understand, recognize, and control risk. There are three main reasons why risk assessment is such an essential element in the investment process. First, since birth, we are taught to avoid risk and focus on certainty. Whether it is our schooling, job, or personal life, we are always risk averse and love certainty in everything we do. So, investors considering a given investment need to judge how risky it is and can he live with the quantum of the risk if the investment fails. Second, as we all dislike the risk so much, investors must be bribed with higher prospective returns to take the incremental risk. So, the returns from investing in a startup must be higher than listed common stock. Common stock returns must be higher than mutual fund returns, and mutual fund returns must be higher than FD returns. The investor need to determine whether the returns on a given investment justify taking the risk. Third, just results do not matter, but the quality of the investment decision and in what environment the results were achieved makes difference. Risky versus safe investments, FD versus stock, blue chip stock versus small companies, bull versus bear market. Traditionally, risk-reward relationship is shown as positive. Higher the risk you take, higher the returns. People have drawn the erroneous conclusion riskier investments provide higher returns, which gets them into trouble. They forget to take into consideration the probability of failure. The correct statement is to attract capital, riskier investments need to promise higher returns. But there is absolutely no guarantee that this higher returns will materialize. So, higher the risk, higher the uncertainty of returns you will get, and the probability of bigger losses increases with the risk. Let's see how this concept works in the real world. In India, government securities are the absolute safest investment, and the 10-year bond yield as of today is 7.3%. The risk of default is minimal as these are government-backed securities. The returns are fixed and there is zero uncertainty on return at maturity. Now consider angel investors who place bets on early stage startups. The average returns expected by angel investors is between 22% to 27% per year. The hard reality is that about 10% of investments exits account for 90% of angels' profits. The majority of startups they invest in go bust and angel loses their initial capital. They need to focus on diversifying their portfolio and invest in more than 50 plus companies to achieve the targeted returns. The absolute returns from any one company vary from 0 to multiples of many hundreds in the case of unicorns which go public. How to define risk? As much of the risk is subjective, hidden, and unquantifiable. The simplest and much accurate definition is the likelihood of losing invested capital or achieving unacceptably low returns on the investment. What gives rise to the risk of loss? Arrogance, failure to understand or acknowledge the risk. Bull and bear markets are created by people's psychology about the value of individual stocks. In a bull market, people are overly optimistic about the future and prospective returns that will be delivered by a company. They invest in the current hot stock or sector and are ready to pay any price for these companies. A recent example I can give is about Adani stocks. The stocks came into limelight post-COVID when markets were hitting all-time highs. The Adani Group companies were trading at price to equity ratios of 300 to 500, which is an unthinkable premium. Investors continued to buy these stocks and failed to acknowledge the risk associated with a high valuation. Hindenburg published a report and the stocks came crashing down. People lost as much as 70% of their value in just 2 weeks. A pragmatic value investor thinks and believes exactly the opposite. They believe high returns and low risk can be achieved simultaneously by buying things for less than they are worth, and overpaying implies low returns with high risk. A value investor will prefer dull, ignored, tarnished and beaten down stocks over hot and market favorites. These stocks will give excellent returns with low variability, low fundamental risk, and smaller losses when the market turns bad as compared to the hot stocks. The biggest risk with value investing is underperformance in a heated bull market, but the risk cautious value investor is okay to live with and accept the risk. If you enjoy the content, then please like, share, and subscribe to my channel.